gold is going much, much higher. I used to think, back in 2009, 10, 11, back when they started QE, I was thinking gold would go to like 5,000, when gold was like 1,000. And it didn't get there. But now that it's 2025 and we've created so much more money and so much more debt than we had back then, I mean, 5,000 is nothing at this point. That's just a pit stop on the road to much, much higher prices because we have to, catch up to all the inflation that we've created. So, now you're looking, gold could be, 20,000 or more. I don't know. But a lot of it isn't gold going up. It's the dollar going down.
Gold has reached an all-time high, signaling a significant shift in global financial dynamics as the US dollar experiences a sharp decline. The dollar has fallen to a 3-year low against the euro, while gold surged above $3,250 per ounce, recording its best weekly gain since 2020. According to Peter Schiff, chief market strategist at Euro-Pacific Asset Management, this surge in gold reflects more than just a temporary flight to safety. It marks a fundamental reordering of global capital. Schiff emphasizes that the expansion of debt and the money supply since the 2008 financial crisis has set the stage for gold to reach unprecedented levels. He predicts that gold, once expected to hit $5,000 per ounce, is now on track for much higher prices due to the massive global economic shifts. Amid this surge in gold, nations such as China and Germany are actively seeking to reduce their dependence on the US dollar, further contributing to the growing sense of instability in the global financial system. China, which holds the second largest stockpile of US Treasury bonds, has been reducing its holdings, a move some experts attribute to growing geopolitical tensions. Germany, in turn, has been repatriating gold from the United States, with calls for further action increasing within the country. Despite bringing back substantial amounts of gold from the Federal Reserve in recent years, Germany continues to push for greater repatriation. These actions by major global economies suggest that the US dollar's dominance in the global financial system is increasingly under threat. As the dollar's value continues to erode, there is growing speculation about the potential return of the gold standard, or, at the very least, a shift toward gold as a key asset in global reserves. Some analysts predict that if inflation and rising debt continue to undermine the dollar, gold could see unprecedented price increases, with some estimates suggesting it could reach $20,000 per ounce in the coming years. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
The Fed needs to raise rates. That's what they're supposed to do. But they're not going to do that. There's no way they should cut. They never should have cut. They never should have stopped hiking. The Fed never got into restrictive mode. That was a lie because credit continued to grow to record levels in the government, in the private sector. That meant that credit was too loose. The Fed never had tight money. Also, look at the price of gold. When Alan Greenspan was Fed chairman, he said that he used gold as a way to tell whether he was too loose or too tight. And he said that if gold got up near $400 an ounce, that meant that he was too loose. And if it got down near 300, that meant he was too tight. Now, obviously, at the time, it was trading at around 350, right? So he was looking at gold as an indicator of whether or not he had the correct monetary policy. Powell watched gold go from 2,000 to 3,000 and cut rates. What was that telling you? Gold was telling Powell that he was making a mistake, that rates needed to be higher. But the reason he's cutting rates is because we're insolvent and we can't afford higher rates. But so I think the Fed is eventually going to cut rates and go back to QE. But they're waiting for everything to collapse, right? Because they don't even know that it's going to collapse. But they're waiting for some signs that the financial system is buckled. Maybe they want to see big layoffs, which are coming. We're going to have widespread layoffs in the United States because the whole service sector economy is going to shut down because all the imports are going to be cut off. So we got nothing to buy. So all these businesses are going to be going into bankruptcy and laying people off. But when the Fed cuts and goes back to QE, that sends inflation through the roof. So it's high and it's going to be a lot higher. and then it sends the dollar through the floor. It's actually going to send long-term interest rates higher. So, we're at the end of the road here. No, it is a long-term shift, and it's been going on for a long time. Yeah. How do you think we got up to 3,200 and change? So, no, but gold is going much, much higher. I used to think, back in 2009, 10, 11, back when they started QE, I was thinking gold would go to like 5,000, when gold was like 1,000. And it didn't get there. But now that it's 2025 and we've created so much more money and so much more debt than we had back then, 5,000 is nothing at this point. That's just a pit stop on the road to much, much higher prices because we have to, catch up to all the inflation that we've created. So, now you're looking, gold could be, 20,000 or more. I don't know. But a lot of it isn't gold going up. It's the dollar going down. When the United States, was first started in 1789, you only needed $20 to buy an ounce of gold. And about 130 years later, when we established the Federal Reserve in 1913, you still only needed $20 to buy an ounce of gold. So the dollar and gold were very stable up until the creation of the Federal Reserve. Now, that didn't change until 1933 with Roosevelt and the Great Depression, and he devalued. And now you needed $35 to buy an ounce of gold. But that was the same until 1971, $35. And then we went off the gold standard completely. And now gold goes from $35 to over $3,000. So gold has gone up more than 100x. But gold hasn't changed. It's the US dollar that has lost more than 99% of its purchasing power. Yeah. When the dollar was backed by gold, it didn't lose any of its purchasing power. It was only when we went to a fiat system that the purchasing power was destroyed. So when I'm talking about $20,000 gold is not more valuable. The dollar is a lot less valuable. And so you need a lot more dollars to buy that same ounce of gold. We don't need a reserve currency. Yeah. We just need a reserve. Money needs to back up currency. So all these foreign countries are going to use gold because that's what they used before the dollar. Remember, in Bretton Woods, we got the world to use the dollar as the reserve instead of gold. They were using gold. But the reason we got them to use the dollar is that we said, hey, the dollar's as good as gold. It's backed by gold. You can have your gold whenever you want. So just back your currency with dollars. And in the meantime, you can buy our treasury bonds and you'll get interest because you don't get any interest on gold. So it seemed like a good deal. Have your cake and eat it too. Yeah. Own gold, but get interest. But then, of course, we screwed them because we defaulted, right? Hey, we're not going to give you any gold. You screwed up. You trusted us. But so the world's just going to go back to a gold standard. That's what's happening. And they may have other currencies in reserve, but the primary reserve asset has got to be gold. Yeah. And that's why there's so much more gold that central banks need to buy.
One of the significant factors driving the surge in gold prices is the active accumulation of gold by central banks as a strategic hedge against geopolitical instability and recession risks. In the first quarter of 2025 alone, official sector purchases of gold reached 387 tons, with China leading the way by adding a record 72 tons in March. This move signals a growing shift away from dollar-denominated assets. For instance, the People's Bank of China has reduced its holdings of U.S. Treasury bonds by 18% since December 2024, while increasing its gold reserves. Such actions indicate China's strategic pivot away from the U.S. dollar, reinforcing the importance of gold as a reliable store of value. The BRICS nations in particular have been accelerating their gold purchases, underscoring institutional confidence in gold as a long-term store of value over traditional currency reserves. These countries increasingly consider gold an alternative to the US dollar, which is viewed as unstable due to rising inflation and global economic uncertainty. The accelerated accumulation by these emerging economies demonstrates their long-term commitment to diversifying reserves away from the dollar. Peter believes that this shift not only reflects concerns over the stability of the US dollar, but also highlights gold's enduring role as a safe haven in times of financial instability, positioning it as a key asset in the evolving international monetary landscape.
Returns that investors will be able to get on global assets. And people can learn more about that at my website, Europe Pacific Asset Management. I mean, we have all kinds of strategies that have been designed to benefit from de-dollarization, and from the process that is now underway. All you have to do is look at what's going on. U.S. stocks are going down. U.S. bonds are going down. The U.S. dollar is going down. It's all being sold, and the money is being redeployed elsewhere.
Hey, we talked about repatriation of gold from, Europe and other countries, but do you think that U.S. is going to add to its stockpile? I mean, any news here if we're going to get back to the gold standard?
Well, where are we going to get money to buy gold? We're broke. We're running multi-trillion-dollar deficits. So how are we going to buy gold? Are we going to just go into deeper debt to buy more gold? No. I mean, it's the countries that have surpluses that are buying the gold and basically to sells. And the analyst said the reason we're downgrading is because gold's at 2,000 and we don't see any upside. Everybody thought 2,000 was the top. Yeah. And I kept saying, no, 2,000 is the new floor. And so Wall Street has completely missed the gold trade. They don't have any money in these gold stocks. Again, they bought Bitcoin ETFs and all kinds of crap. Bitcoin, since it peaked in November of 2021, is down more than 30% in relative to gold. MicroStrategy or any of this nonsense. I just came out with a special report. People can get it for free at Euro Pacific Asset Management, Europac.com, a special report, the best way to buy gold, in which I really make the case that gold mining stocks have never been cheaper than they are right now, and that's how you got to buy gold. Mm-hmm. Even though gold's going to go up, the gold in the ground could go up much more. And then, when you triple, quadruple your money in these gold stocks, which I think you could do very quickly, then take some profits and buy more physical. Yeah. Even if the physical has gone up, it won't go up nearly as much as these stocks. So it's like a once-in-a-lifetime opportunity to take advantage of the fact that everybody's been asleep. The central banks have been buying gold, and they haven't had any competition from private investors. Well, when private investors wake up, especially the endowments and the pension plans and then the hedge funds, when they finally realize that they've got it wrong. Remember, all the experts said that tariffs would make the dollar go up.
Industry leaders are expressing increasingly bullish views on gold, with many citing the growing uncertainty in global financial markets as a significant factor driving this optimism. As global economic and geopolitical instability continues, analysts see a favorable environment for gold's price to climb further. According to some, the market sentiment is strong and has the potential to grow even more robust as investors seek safer assets to hedge against risk. The gold demand is bolstered by concerns over inflation, currency devaluation, and shifting geopolitical dynamics. As more institutions turn to gold as a store of value, its appeal is expected to strengthen, especially as the future remains uncertain. Major investment banks are revising their price forecasts upward, with Goldman Sachs projecting gold to reach $3,500 by year-end, reflecting growing confidence in the metal's ability to weather global economic uncertainties. In a similar vein, Citigroup analysts suggest that gold could peak at $3,800 under specific geopolitical scenarios. These revisions highlight a shift in market sentiment, as the precious metal remains a key safe haven asset amid rising risks. The adjustments in forecasts signal a broader institutional belief that gold's value will continue to rise, driven by inflation, currency instability, and geopolitical tensions. That's it for today. Share your thoughts on Peter's analysis in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.